Join the computer audio.
Clients. So kudos to you, Ripley team.
Awesome. One of our mainstays is be learning based, right? We're always to be learning based. There's always things to learn. So that's fantastic. Who else has a bucket to fill?
Hey, this is Michelle. I do. I'm so appreciative of David Jones for taking his time. I know he's super, super amazingly busy, like the craziest busy could ever be. So for him to take the time to do the business planning clinic, which was really, really valuable. I just want to say thank you. Thank you to David. That was awesome.
Awesome. That's
and
great.
Of course, all the support staff, right, who put it together. I think it was just so helpful for all of us agents. Thank you.
That's wonderful to hear, and we are very thankful. And I think the event went off really well. It was nice attendance. It wasn't too crazy, and it was good. So I appreciate that. Who else has a bucket to fill?
I would like to fill Debbie Chop's bucket.
Okay.
Debbie Chop, thank you so much for your attendance at the Business Planning Clinic, as well as our Friendsgiving, and bringing along those awesome photographiers that you had doing some video stuff for us, and always being a valued partner to us. Thank you so very much for all that you do for not only our agents, but also our business, and being an amazing person. High five to you.
Thank you. The video will be ready on Friday. It's looking really good.
Awesome. I think that the correct terminology is the Chops Minions. Is that what we're
Chops Minions, got it.
Minions. Okay, awesome. I 100% agree, Dan. Thanks, Debbie. Who else? One more.
I got one.
Information.
I have one. I'm guessing the bucket is everybody's, saying thankful things. Thank you for having me to the team. My name is Ricky. I'm new. I'm my first meeting with the team and everything, and I'm happy to be on board.
Awesome. That's great. And I love your screen name is Lil Ricky. So you will forever be known as Lil Ricky. So
hi, Lil Ricky. I'm Big Dan.
Yeah, Big Dan, Lil Ricky. Medium J.
Hi, we are completely set.
All right. So let's go. Let's move forward there. Kayla, you're running the show. Somebody's running the show. Perfect. All right. So I saw both Lindsay and Colleen. I'll let you guys both have a little chance to throw some stuff in there. Tell us what's going on with Catalina.
Good morning, everyone. I'll pop in real quick. Well, I did my shout out for part of it. We just want to thank everybody for showing up for the title class. We love bringing classes to the office. We will get with Kayla, so we can set up some more. I know Trisha did the life of the estimated cost sheet, and that was a great class. Anybody that would like some more information on that, or if you missed one of those classes and would like to get with us one-on-one or set up another class where we can get some new agents, to go over the prelim, we'd love to do that. So thank you for your business. We appreciate you. We appreciate you remembering both title security / Catalina title on your contracts and your listings. Thank you. That's all I have.
Awesome. Lindsay, you want to pop in real quick?
Hey everybody, it was good seeing everybody at the Friendsgiving. Again, with Colleen, we're here to offer classes for the new agents that haven't reached out or that we haven't been able to connect with. Please feel free to reach out to us. I would love to meet with you. I take care of the Kolb office and Colleen is over at the River office. I think that I've had several meetings lately. So Jay and David and Dan, I know people have had good meetings with Dan, and this is just such an awesome group of people. So please reach out. It's good to see more people on here getting connected. I know for the newer agents, it's a little bit difficult to try to connect with the agents. So just a reminder to everybody on here, reach out to those new people because they're out on their own right now. So but I'm here for you guys, and I look forward to meeting more of you. Oh, I see Jennifer's on. Hi, Jennifer.
Awesome. Fantastic. Thank you so much. Trisha, do you want to add anything?
I do, if I could, just a quick message. Jay, you and I've talked about this in the past 3 to 4 years. We've done the Salvation Army bell ringing, and you can imagine this year these folks are really hurting because they haven't been able to do as much fundraising. Well, I got a phone call yesterday saying that the AJs, where we've done the bell ringing in the past, is a part of BASHAs, and they're not going to do any bell ringing outside. They're trying to be careful with COVID. Totally get that. But what they are going to do is they're going to do a virtual red kettle. So what I'm going to do is I'm going to get online and I'm going to set up a team for us. And it's kind of cool because if you'd like to at least put something on social media and say, hey, Keller Williams has a team and we're trying to support the Salvation Army. You know, if you'd like to join me in raising some funds, that's a possibility. I mean, it's just a good way to reach out to your customers, even if they don't make a donation, they know what you're up to. So Jay, who would I let know about that team once I get that set up?
I think that's probably a Kayla Shinnick.
Okay.
Piece of
Okay. I'll get on that pretty quickly.
Yeah,
and
Kayla and Ashley here.
Ashley,
we'll round up and get the information disseminated.
Okay, and what they'll do is I'll send directions so you'll know once the team is set up. You don't make a team, you just join the Keller Williams team, and then they'll keep track of how much we actually raise, and they'll let me know that. And because last year, by the way, you guys, we knocked it out of the park. We were the #1 real estate group that did fundraising for the Salvation Army, and that was a big deal. So I thank everybody for doing that. It was a lot of fun. Hopefully we'll be able to do it again next year. Thanks, Jay.
Awesome. Thanks, Trish. Appreciate it. All right, Debbie Chop, you're gonna give us some
My
updates.
mortgage minute. I have my stopwatch. I was a trend coach, so I will stick to it. Rates are low, inventory's low. We know that. That is a huge opportunity for you guys to do new builds. Historically, when my clients want a new build, they're getting a new build. It's just where their head's at, right? So if they don't fit into the finance bucket for the new build in-house lender, we have a new program at Fairway just for new build clients. Hit those timelines, hit all that earnest money, much better rates. So if you're falling into the trap where your client's getting a new build, they just are, and it's too stringent, the qualifications for the in-house lender for new build, call us. We have some excellent programs and we've just been crushing those. And that's your mortgage minute. 46 seconds.
That's really good. That's awesome. Great job. Appreciate that. All right, I don't see our warranty people on the call, so let's move forward with broker tip. Excellent. I saw Lisa Sullivan's smiling face on there.
I am here. How many of you know that the NAR convention is going on right now virtually? Some of you? Yeah. Well, it is. It's happening right as we speak. There's actually John Legend speaking on fair housing right now, which I'm going to join in a second when I'm done here. But one of the things that's happened is the NAR Board of Directors has passed some changes to Article 10 of the Code of Ethics. And what that is it addresses hate speech and discrimination, which is obviously very prevalent right now. What it's saying now is that you may not use harassing speech, hate speech, slurs, anything at all that is considered harassment in any type of in anything you do. Also, they've now passed a policy statement that makes it a violation whether or not you're practicing real estate. So anything you do as a licensed realtor, everything you do is under scrutiny, and you have to abide by the Code of Ethics, whether or not it's, excuse me, while you're practicing real estate. That includes social media. If you don't like something you see on social media, pass it by. Don't feel like you have to interject or engage in things that you may or may not feel strongly about. If you see something that is blatant discrimination, bring it to my attention and I'll address it as the broker. But please be the bigger person. Pass by. You do not need to engage with people that you disagree with. And it's going to affect your job if you do that. And also it's just the wrong thing in general to do.
But Lisa, how am I supposed to convince people to think like I think if I don't engage them on social media? Oh, wait, never mind.
Take them to lunch, have a conversation.
I'm sorry, John, what did you say? Yeah.
He said take them to lunch and have a conversation.
Right. Yeah. And, you know, be the bigger person. You don't have to win every argument, especially if it's something that isn't worth fighting over. And don't forget, we have a regional director of diversity, Kathy Boston, who has a lot of resources available for you. If you need help or you need to talk to somebody about anything that may be on your mind or you don't understand, reach out. Reach out to any of us in leadership and we'll help you. A lot of times it's unconscious bias that you aren't even aware that you have. And it's really prevalent right now. So be careful, be cautious, take the high road always, and do the right thing.
That is a good broker minute. Thank you. All right, Cindy Powell, you're up.
Good morning, everybody. I have just recently come off of 2 days of spending time with my family in Texas. They actually came to Arizona to visit me, so that was pretty awesome, but I missed everybody dearly. One of the things that came to my attention while I was out and after I came back, we are in the process as an MCA department of managing our projected. So every time you do a green sheet or a DA, we send a DA to you, that puts your closing on a projected path to close in the market center. The date that you enter on the green sheet is the projected date of closing. It's the MCA department's task to project the income for the market center every month. And so if we don't know if your closing closed and it's still on our projected report, we will be reaching out to you with an email that says, please let us know of the updated close date. Now, we have received some emails back that said the information's in the loop. We're not allowed to look in the loop and review documents because no one in the MCA department is a licensed real estate agent. And so we can't go to your loop and review your documents to find your close date. So what would really be beneficial to us is if you have an addendum that extends your close date either from the 1st to the 31st or from the 31st into the next month, if you could just email us at revisions@1kwsa.com and let us know that. When that happens, we will update the information in our system, and then we'll all be on task for what's projected coming into the market center. This is a really important task that we do as an MCA department. It helps our team know the direction that we're heading and where our agents need the most help. And so please be sure to notify us. Also, if you receive an email from someone on the MCA staff, which in this case will be Tiffany, as an assistant MCA, she'll send you an email and ask you for updated information. Please reply back with the closing date as it has been updated according to your documentation. If you have a transaction coordinator, just forward that email to them or let us know who your transaction coordinator is and we'll reach out to them. And as Tiffany learns more and more the agents over here at the JV office, she's pretty familiar with the KLP agents, but as she learns the 495 agents, she will just kind of know that stuff, you know, automatically. So you're helping train us as we help train you. But don't reply back with an email that says it's in the loop or it's in commissions, because that does not help us at all. And we really need your help to be able to do this well for our market centers. So please email revisions@1kwsa.com with updated closing information, especially if it's being pushed into the next month. Another reason why this is really important, let's say that it's pushed into the month of December and you reset in December. We have to then go in and update the DA so that it reflects your reset anniversary date. And then that way we can make sure that title has an accurate DA for you. And so help us out with that. We really appreciate everything that you do, and watch out for those emails. Tiffany will be sending those probably weekly to confirm closings that didn't happen that week. So we appreciate your assistance. Thanks so much.
Thank you, ma'am. All right, I'm going to have Kimmy Roberts jump in real quick before we go to the Ignite slide. So Kimmy, you have something you want to address about culture?
Yes. Hi, good morning. Thank you, Jay. I just wanted to jump on quickly and tell everybody thank you that was able to come in and participate with our Friendsgiving event last week at Topgolf. We had a great time. We did have a small goal to give back to Habitat for Humanity, which is who the Culture Committee has committed to for 2020. And we have reached that goal. I believe we've exceeded that goal we are going over the numbers with the MCA department so that we can share what we were able to, what we are going to be contributing after the end of this week. I also wanted to share that the Friendsgiving that we held in Sierra Vista at the Sierra Vista office, I was able to join that yesterday, and it was very successful. There was a lot of thankfulness, there was a lot of gratefulness, there was a lot of coming together, and it's just such a joy to be able to share that culture with all of our agents and all of our market centers. So thank you all that have been able to participate.
Awesome. Thank you very much, Kimmy. I hope that we made our goal. All right. Ms. Kayla Shinnick, you have a note about Ignite coming up.
Big Dan's taking it away.
Oh,
Okay.
yes. Ignite is coming up on Monday, this following Monday, the 23rd. So if you have not gone through the Ignite course, you are a new agent to Keller Williams, you're newer in the business, or you just want to fine tune your skill sets, come join us for the last Ignite of the year. We are doing it remote access. We have some new instructors this course time. So please jump in, join in, participate, grow your business, and give yourselves a cutting edge going into 2021. That's it. I got it.
So it starts Monday.
Starts Monday.
Monday, and no class, obviously, Thursday or Friday.
No, sir.
Awesome. You guys definitely need to participate. Lots of good. Ignite 2.0, I think is the best class. I think it's really good to help not only new agents, but agents that want to fine tune, want to be learning based and hear other newer ideas. So awesome. All right. Well, anything else? Yeah, no team meeting next week. We will have not next Wednesday, but the following Wednesday will be stats with Aaron Wilson. So make sure you put that on your calendar, and we're ready to go. So we have a guest in the house today to give you guys just a ton of knowledge that's going to help you as it comes tax time. So I want to introduce Derek. Is it Ungaren?
Yeah, Derek Ungaren.
Ungaren with Ludwig, Kluwer, and Rudner. So Derek, the floor is yours. I think someone's going to give you access to share your screen, and you got your slides, so you should be good to go.
Can everyone see the PowerPoint all right?
Not yet.
There we go. You got it.
Perfect. So yeah, my name's Derek, and I've been a CPA here in Tucson for about 10 years now with Ludwig, Kluwer, and Rudner. And today we're going to go over some tax strategies for PLLCs. And I'm really hoping this information will be helpful for everyone that's new to the business, trying to get everything set up, as well as those of you who have been in it for a while. Make sure that you've got everything optimized to save you the most money tax-wise. So first, we're going to just briefly go over what a PLLC is and all the various tax categories that you can have if you are a PLLC. We'll go over the pros and cons of all of those so that you can kind of have an idea in your mind what is best for your specific situation, followed by a little bit of information on what you can deduct, because that's always one of the biggest questions we get is, what can I deduct for tax purposes? Then we'll briefly go over the payment structure now that you're your own employer, and some of the recent tax updates. I know questions are a little hard via Zoom, so feel free to shout out if you have questions during the presentation, and I'll try to stop after each section, give everyone some time.
How about we have them enter their questions into the chat, and that way we can bring them to you as they come in.
Perfect. Let me make sure I've got my chat open.
And we'll monitor and bring it to you. So you just worry about your stuff. We'll bring the questions to you.
Perfect. Okay. So first, what is a PLLC? And it stands for a professional limited liability company. And essentially it's the same as an LLC, which you hear very common when you're dealing with small businesses. The main difference is that a PLLC is for licensed professionals. So in the state of Arizona, if you're a licensed real estate professional, you can form a PLLC. The main reason why many people form a PLLC is for the legal protection. And essentially what it does is it separates your business from your personal assets so that if anything ever were to go wrong and you were to get sued, whoever's suing you can't, take your personal residence and your personal cash. They only have access to what is in the business. The other main reason people form a PLLC is for the various tax structures. There's several structures that are available when you become a PLLC. There's a sole proprietorship, a partnership, an S corporation, and a C corporation. We're not going to really go into C corporations that much because it's probably the least common used in small businesses. So when you're starting off and you're trying to decide, should you form a PLLC, there's a few things to consider. One is, the tax benefits of the various structures that you can form. I would say the main one that people consider is the liability protection. But then you also have to consider what you want to do with the business going forward. Is this going to be your main career? Are you only doing it for a few years? And you also have to consider all the expenses involved with being a PLLC. So if you decide that you do want to form one, I always recommend contacting an attorney and a CPA. The attorney can help you, form the actual legal entity of the PLLC. And the CPA can, help you decide what kind of tax structure, get you your EIN. If you decide that you want to be an S corporation, CPA can help you out with that. You should open up a bank account to keep, the PLLC funds separate from personal funds, which is a big deal for most of these entities. Just make sure you're running everything out of that separate bank account. We always recommend, get with a bookkeeper as soon as you start, have a good set of books. That not only helps with your taxes, but it's also going to help you as a business owner, knowing where you're at, helping you make decisions throughout the year. And then if you do decide to be treated as an S corporation, you also have to pay yourself a salary, but we'll go in that a little bit more later. Are there any questions on kind of forming the PLLC?
None in the chat, Derek.
Perfect. So the first tax structure that's available is the default structure if you're the only owner of a business. If you form a PLLC and you don't do anything else and no one else has any ownership, you are automatically a sole proprietor. And the good news with that is it's probably the easiest of all the structures. You don't need to file a separate tax return. Everything goes right on your individual tax return each year on Schedule C. It's also really easy because for tax purposes, the IRS looks at you and the business as essentially being the same thing. So there's no special rules on taking money out of the business, putting money into the business, anything like that. One of the downsides of being a sole proprietor is that all of your income is subject to self-employment tax. And this is one of the key topics that's really important for every new business owner to know because it really catches people off guard. So essentially, when you're an employee somewhere, every year you get your W-2 and there's 2 boxes on it that say Social Security tax and Medicare tax. And those are taxes that every paycheck your employer holds some back and sends it to the government. And most people don't pay too much attention to it because they never actually see that money. When you are self-employed, you have to pay what's called self-employment tax, which is essentially your Social Security and Medicare. And not only do you have to pay your half as the employee, you also have to pay the employer's half. So that really catches new business owners off guard because they see this huge extra amount of tax that they think they weren't paying before. It's really important to keep in mind that you're always paying this tax. It's just whether you pay it at a lump at the end of the year or through your paycheck every pay period. You do receive a deduction for it as a business owner. But most people, when they see the self-employment tax, their main focus is, wow, I just filed my tax return and I owe a lot more than I ever have in the past. So the major pros of being treated as a sole proprietor is that the documentation required is far less than the other entities. It's the simplest, it's the least expensive to be. But the cons are that all the income is going to be subject to self-employment taxes. And you're limited to a single owner. If you want to bring on partners or someone else, they have to be employees of you. They cannot be an owner. A partnership is the next structure available, and this is the default structure when there's more than one owner.
Hey, Derek, can I interrupt? We had a couple questions pop in. Number one, we had someone bring up that to make sure that once you create your PLLC, you have to inform ADRE so that they can reflect that name change, your business name attached to your license. And
Mhm.
question number 2 was, how does the Social Security tax and Medicare tax equal 15.3%?
Okay. So for the first question, when you form the PLLC, you apply for a tax ID number. That's an EIN.
Mhm.
And that's going to be the ID number that you give to everyone to run, basically all your business activity through.
Mhm.
So for example, you get a 1099 at the end of the year that says this is how much income you made. Once you form the PLLC, that's going to be under the PLLC's name and tax ID number. So
Right.
once it's formed, you'll use that for all of your filings. And the self-employment tax gets to 15% because not only are you paying the 6.2 and 1.45 as the employee, but you also have to pay the employer's portion. So when you're an employee, your boss is paying those taxes and you never know it. But once you become self-employed, you are now responsible for both halves of that tax. Any other questions on sole proprietors?
That's it right now. Thank you.
Awesome. So yeah, the partnership, how it works is there is a new required tax return once you become partnership. So how that works is you file a tax return, it has all the income and expenses on it, and then all the owners receive what's called a Form K-1, and that reports their share of the income and expenses, which they then report on their individual tax return. It's very important to know that these partnership tax returns, there's no tax due from that. All the tax is still paid by the individual owners. And so the actual tax return that's being filed is known as a pass-through entity because all the income just gets passed through to the owners. Another important thing that new business owners are always thrown off, you get taxed on the income of a partnership, whether or not you take any cash out. If your share of the income is $1 million, you're paying tax on $1 million, whether or not you take out a single penny. The benefits of being a partnership is it really allows a lot of flexibility for multiple owners. If you've got 2 partners and one makes $1 million during the year and one makes 100,000, you can work into the agreement that you pick up tax for what you earn. With some of the other structures, you'll see you don't have the ability to do that. That also applies to cash being taken out. If one partner wants to take $1 million out of the partnership and one only needs 100,000, you're allowed to do that, which you aren't allowed to with the other entities. The majority of the income is going to be subject to that self-employment tax. Depending on the type of business that you're in, there might be some income that won't be subject to it, but the overall business income is going to be subject to self-employment tax. And then typically partnerships do have additional expenses associated with it. Things like accounting fees for bookkeeping, additional tax returns, extra legal documents being put together. And so it is more expensive than being a sole proprietor. So the real benefits of being in a partnership is the flexibility. You can really work into your partnership agreement any sort of allocation that makes business sense. And so it's really preferential for people that want stuff like that worked into their agreement, whether it be earnings or money coming out. It's also the easier entity to either add additional partners or when you're ready to retire, sell your partnership. Changes in ownership is really flexible. The cons are that most of the income is going to be subject to that self-employment tax, and there are the additional requirements as far as legal and accounting fees.
Hey, Derek, I have a question in the chat box about sole proprietor.
Okay.
And her question is all your income subject to the to that self-employment tax? Her question is that income received from your business, or is that all my income from a pension and spouse's income that isn't part of the business?
So it's only going to be the income from the business.
Correct.
And it's important to know, being a sole proprietor, if you have any other sources of income flow in, let's say the business has a large bank account and they earn a couple $1,000s in interest income, Any income that is not business related gets reported separately. So it only applies to the actual business income earned.
Thank you.
So S corporations. To be taxed as an S corporation, there is a special election that needs to be made, and you do this by filing a Form 2553. People are able to do this themselves, but more often than not, I see their bookkeepers filing this for them. And when you're an S corporation, one of the benefits is you can be a single owner or you can have multiple shareholders. Similar to the partnership, S corporations file its own separate return and issue all the owners K-1s to report their income on their individual return. The big plus side of being an S corporation is the income is not subject to self-employment tax. To make up for that though, the owners are required to pay themselves a reasonable salary. And this is probably the most important part about an S corporation, because the real benefit is that you save on the self-employment tax. And to make up for that, the IRS says, okay, you have to pay yourself a salary, because when you issue yourself payroll, you're paying those Social Security and Medicare taxes through payroll. And I always get the question, what's a reasonable salary? Because people go, okay, well, if I make $1 million, I can pay myself a salary of $10,000, and then I'm only paying these taxes on $10,000. And kind of the standard questions I say to come up with a reasonable salary is, if you were paying someone to do this, what would you want to pay them? And if you were working for someone else, what would you want to be paid to do this job? And typically the reasonable salary falls somewhere in between those two numbers. People are always tempted to pay themselves a lower salary because that saves them the most on taxes. And it is kind of a gray area for the IRS because reasonable salary is literally the only guidance they have for this. And so it's a very hot topic. With S corporations, one of the downsides are the income allocation and distributions have to be pro rata based on ownership. So if you're the only owner of an S corporation, that's not a big deal because you're the only one. You can take out and put in as much as you want. Where it starts to become issues is if you're a 50-50 owner with someone else and they take out $10,000, you're then required to take out $10,000 of the business. Similarly, if you put in money, the other owners have to put in a proportional amount of money as well. I see a lot of problems arise in this area because business owners aren't necessarily aware of these requirements. And so they'll start taking out money at the end of the year, and then we have to have the business pay out to the other partners. And it becomes very messy if you're not aware that everything has to be pro rata. So the biggest pro with this is the self-employment tax savings. I would say probably the majority of our small business clients in real estate elect to be treated as S corporations simply because of this savings. The downsides are it is the most expensive legal and accounting fees. And if you don't already have employees on payroll, you have to start paying a payroll processor to get that done. You do have the additional record keeping requirements, and all the distributions have to be pro rata. So while it does take the most work to operate as an S corporation, the tax savings can be pretty significant, which is appealing to most people. So kind of as an example of how the self-employment tax would work, if you are either a partnership or a sole proprietor and you make $100,000 in 1 year, you're going to be paying $15,300 in self-employment tax. And it's important to remember that this is a separate tax from your ordinary income tax. So you'll be paying that $15,300 plus what you would with $100,000 of income.
Hey, Derek, one question that popped up. On an S Corp, as a single owner, do I run payroll for myself?
Yes, so you are required to run payroll for yourself as an S corporation. Normally we say, first year, there might be a little bit of leeway if you form it kind of in the middle or towards the end of the year. But if you have an S corporation that's profitable and you're not showing any payroll, that is a large red flag for the IRS.
And that probably needs to be done through either through a QuickBooks payroll service or another outside vendor payroll service. Would that be right?
Yes, I always recommend having an actual payroll provider run it. Most bookkeepers do payroll as well, but if you try to do it yourselves, I've seen a lot of issues where the proper forms don't get filed or proper tax deposits aren't made. And it's a lot easier to just have someone do it, and then you can kind of plan for everything accordingly.
Yes, awesome.
Okay. So an example for an S corporation in a similar situation, if they had $100,000 of profit, they could choose to pay themselves a salary of $50,000. So on their individual return, their total income's the same because they have $50,000 of wages that they received and $50,000 of business income. So the total income is the same, but they're only going to be paying Social Security and Medicare taxes on $50,000 instead of $100,000. So in this example, they would save $7,650 in self-employment taxes. Now, this is a situation where being an S corporation would likely make sense because, if you have to pay a couple extra $1,000s a year for accounting, legal, payroll, stuff like that, you're still saving, $4,000 or $5,000 a year. If that profit was only $30,000, it might not make sense to make this election because the tax savings wouldn't be enough to cover all the additional expenses. So when you're trying to consider which of these tax structures is right for you, it's really important to consider everything, the cost of the tax savings versus what you have to pay to be that type of entity. Are you planning on working with people? If you are you going to be adding and removing partners frequently, or is it just going to be you and one other person the entire time? Do you want flexibility worked in on how to take cash out and allocate income? Or are you comfortable just leaving it pro rata based off your ownership? And then also important thing to consider is where you are in your business. If you're close to retirement and you only want to work a couple more years, it might not be worth all the additional work and expenses to form these entities. But if you're just getting started and this is going to be your career for a long time, then you've got a lot of potential to save on taxes by making this S election possibly.
Hey, Derek, another question that popped up. So those expenses that we were discussing with the S Corp, your expenses for your bookkeeper, your payroll processor, legal, and accounting, those are all tax deductible expenses, correct?
Yes, all of those are going to be tax deductible.
Thank you.
Do we have any other questions on kind of the tax structures before we go into what you're able to deduct and some of the recent tax updates?
Does that election, Derek, I mean, that's a one-time election, correct? When you're setting it up, you elect which direction you're going to go. So you want to make sure that you're pretty clear on the path you're going to follow, not just the step that you're on today, but where you're going in the future will help you select.
Yes, so there are special rules. If you start off as a sole proprietor or partnership, it is a lot easier to become an S Corp after the fact. But once you become an S Corp, it's a little bit more difficult to go back to being a sole proprietor or a partnership. And there's special rules where, if you are an S Corp and then you decide to become something else, there is a waiting period to be treated as an S Corp again. So typically, if you're just getting started and you're unsure the first year, partnership or sole proprietor is good. But if you're, getting started at the beginning of the year and you have the entire year to decide, it makes sense to get with someone and kind of talk about where you expect your income to be and decide if the S election is right for you. So what can you deduct when you're working for yourself, whether you be a sole proprietor, partnership, or an S corporation? And the simple answer is anything that you need for business and that is reasonable. The reasonable part, common sense. If you go out to a bar and spend $1,000 in one night, that's probably not going to be a business expense. So I do have a few slides of just some generic expenses that are pretty common for the real estate profession, stuff like advertising, business gifts, license and permits, business meals, vehicle expenses, cell phone, any computer equipment and software you need, dues and professional fees, anything for continuing education, any office equipment or general expenses, insurance, internet, listing fees, lockbox fees, supplies, anything for your open houses, services, photography, postage and delivery, professional and legal, referral fees, retirement plan contributions, franchise fees, stationery and business cards, taxes, travel, and any wages that you pay. A few of those that I want to highlight are, first, advertising is obviously a big one in the real estate profession. Any of the signs or materials, if you pay for TV ads, anything like that, that's all going to be deductible. Business meals is one of the ones we get the most questions about. The rules on this changed in 2018. So entertainment is no longer deductible. So if you have a client and you take them to a sporting event or something like that, that is no longer a deductible expense. We always recommend you keep your documentation for any expense because this is an IRS hot topic and it's always good to have support for anything that you're going to deduct. If any meals are for business purposes, 50% is still deductible. So that was a big question a few years ago. Are my meals still deductible? And the short answer is yes, 50% of them if they are for business purposes. Vehicle expenses. This is probably the biggest one for real estate workers on average. And it's just because you guys drive so much. To deduct these, you have the option to either deduct the actual expenses or a standard mileage rate. I almost always recommend doing the standard mileage rate. It's more beneficial in most cases, and it's a lot easier. If you decide to do actual expenses, you need to keep receipts for every time you get an oil change or fill up gas, all your car insurance, and then you need to basically prorate it based off how many miles you drove during the year that are business related versus total miles driven.
Hey, Derek.
Either way, yeah.
Never mind. You finish your thought, and then I got two questions.
Okay, I was just saying, either way, it is very important to track your business mileage. We've had several clients that get notices from the IRS saying they're questioning the expense, and they've had to go back and recreate mile logs for an entire year. So just track your mileage throughout the year. You can either do it the old-fashioned way, paper, pencil, or there's a ton of apps out there these days that'll track your business mileages for you.
Absolutely. Hurdler, there's all kinds of ones that I'm sure NAR has some partnerships as well with different apps that help you track that. But it's as easy as you get in your car, boom, click, that you're like on the clock. And then when you get to your destination, click, you're off the, and it calculates all your mileage. You don't have to worry about your odometer. Here's the questions that have come in. So there are questions about expenses. What about licensing education prior to establishing the PLLC, but directly related to establishing your business? I'm suspecting if that's in the current year, that would be okay. But if it's a previous year, that would not be okay?
Yeah, so if it's a previous year, you're not going to be able to benefit from it.
Mm-hmm.
If it is in the current year, you do have some more flexibility. Oftentimes we consider that as it's the same business and you just became the PLLC during the year.
Mm-hmm.
So if you do it in the same year, those licensing fees will still be deductible.
Gotcha. Question number 2 is, what about client parties? We didn't necessarily see that in the list. That would definitely go into marketing, and I don't think would be any different than like paying to have your face on a shopping cart, as long as you have the actual, keeping the documentation of the client party.
So that's a little bit of a gray area, and it really comes down to the facts and circumstances for each individual client party. Is it excess and lavish? The IRS might consider that non-deductible, but if it truly is, just kind of a standard client party, then yeah, those probably would be deductible expenses. Really, each situation is going to be different, but I would say overall, you should be able to deduct at least a portion of those.
Gotcha. Two more. Are the deductions limited to the income in my PLLC, or can I use expenses beyond the income to offset my W-2 income?
So that's a really good question, and it's a little different for each business structure. As a sole proprietor, if you have more expenses than income, it will offset other income like W-2 wages or investment income. As a partnership and an S corporation, it can do the same thing, but it really depends on individual situations. When you form a partnership or an S corp, you have what is called basis. And essentially that's money that you put in to start the business, and then it goes up for all your income, goes down for all your losses, and goes down for all the money you take out. So as long as you still have basis in the company and it hasn't hit zero, you can deduct losses against other income.
Gotcha.
If your basis hits zero, then those losses get carried forward year after year. And once your basis goes back up, then you can deduct those expenses.
Gotcha.
So it gets a little bit more complicated, but the short answer is yes, you should be able to.
Awesome. Thank you.
Okay. So another IRS hot topic is going to be cell phones. You can deduct cell phones for business use, but we normally recommend that you take out some portion of it for personal use. Even if you have a separate phone that's your business phone, realistically, most people end up using it for a personal call here or there. So we just always recommend carving out, a reasonable portion for business and personal use. Home office expenses is going to be a big one this year with, COVID obviously, and so many people working from home. And you are able to deduct a home office based on the square footage that is used strictly for business versus the total square footage of your home. We almost always recommend people use the simplified method, which is $5 per square foot, and it caps out at $1,500. That makes it a lot easier because you don't need to track all your individual expenses. And it's just overall, in the long run, ends up being better for most people. It's important to note that this deduction is not available if you're a W-2 employee. They got rid of that in 2018. So it's only available if you are either a sole proprietor, a partner in a partnership, or you own an S corporation. And then retirement plan contributions. This is one of the most beneficial deductions available to you as a business owner. Because unlike all the other deductions, this is money that you get to keep. It goes into your retirement account and you'll pay tax on it when you take it out. But in the year you make the contribution, you get a deduction. There's multiple types of plans. There's simple IRAs, SEPs, 401ks, and each one kind of depends on your individual situation. And I recommend getting with a CPA to go over them. The rules on how much you can contribute depend on if you have actual employees that work for you and how much you make. If you do elect to be treated as an S corporation, all of these contributions are going to be dependent on what you pay yourself in salary. So that's really another item to consider if you make the S election is you want to keep your salary low so that you pay less Social Security and Medicare tax. But at the same time, you want it to be higher so that you can contribute as much as you can to a retirement plan. All right, so paying these taxes, and this is another area where I see people really struggle in their first year. When you're an employee, you've got withholding coming out of your W-2 that normally covers all your taxes and you get a refund. Once you form a PLLC and you start paying taxes with quarterly estimates, most people get shocked because they're paying large chunks of money at once instead of steadily throughout the year. And they also have that self-employment tax to pay. So typically when we set people up to make their estimated payments, we always have them pay 110% of last year's taxes. And that just gets you into what's called the safe harbor. So if your income goes up $1 million, you're still not going to owe any penalties or interest. If you try to guess how much you're going to make and pay that and you underpay, then you might owe some penalties and interest throughout the year. But essentially, once you form your PLLC and start working for yourself, you're going to make a payment every April, June, September, and January 15th. And that's going to take place for your withholding. If you're an S corporation and you have some withholding on your W-2 that you pay yourself, we normally still recommend paying these quarterly estimates because it's going to cover the rest of your business income that you're going to owe tax on. Do you have any questions on anything there?
Hey, Derek, there was someone that mentioned that there is a total write-off dollar amount in 1 year for a specific vehicle size and weight.
Mm-hmm.
Is that amount?
So yeah, if you have a vehicle that is strictly for the business, there is a limitation on the first year of, I believe it's 18,000 or 18,500. And that's what's called depreciation.
Right.
So if you buy equipment, you're allowed to write it off over the life of the equipment.
Mm-hmm.
But there are some special rules that let you take 100% for some equipment in the first year. I normally don't recommend. Was there a question?
Yeah, Sean, ask that question, please.
Yeah, I was going to tell you last year I took a total write-off of up to $60,000 because I bought a vehicle that was specifically for the business that was over 5,000 pounds.
Mm-hmm. So that is good. But one thing we always caution about doing that too is now when you sell that vehicle, when you're done with it, you are going to have gain on the sale of that vehicle.
Unless you drive it for 5 years.
So even if you drive it for 5 years, when you're done with it and you sell it, whatever you get in proceeds, that's going to be a taxable gain for you. And so
just donated after 5 years.
Yeah.
Yeah. So there are workarounds like that. And, I always just recommend talking because every individual situation is different. Also depending on the vehicle, because if you're going to spend $20,000 on a vehicle, you can get a $20,000 deduction. But if you're driving, 30,000 miles a year, the mileage deduction is likely going to be higher over the life of the vehicle. So every situation is a little different, but that is something to be aware of. If you are going to buy a vehicle, I recommend, talking to a CPA to make sure it makes more sense to purchase the vehicle in the business and whether it makes sense to take mileage or actual expenses.
Awesome, thanks.
Okay, so some of the recent tax changes over the last few years. First one I want to go over is the Tax Cuts and Jobs Act. We're in our 3rd year of this now, so most people should be semi-aware of some of these changes, but they were pretty significant. So first, just an update of the tax brackets for next year. They get prorated every year, so this is where we are currently. So some of the changes is alimony. Anything that was entered into after 2018 is no longer deductible for the one paying it and no longer considered income for the one receiving it. Moving expenses were also eliminated, which I'm sure you guys get that question a lot. The only exception for this is if your moving is due to military, then they are still deductible, but otherwise moving expenses are no longer allowed. The standard deduction nearly doubled in 2018, and you get some additional deduction if you're over 65. Most people now aren't taking the standard deduction. With it increased so much, it's just the majority of people are taking the standard and not itemizing. Tax Act also eliminated the personal exemptions. Previously, you would get a little over $4,000 for everyone in your family, and you get to deduct that as an exemption. But to make up for that, they did add increased child tax credits. So if you have a child, they can qualify for a $2,000 credit each, which helps some people, but it's all an individual situation on how much you're going to benefit for that. And if you make too much money, you also won't be allowed to benefit from those credits. For itemized deductions, some of the major changes is they got rid of the overall limitation. Before, if you made too much money, the benefit that you're allowed to receive got reduced. They did also change it to 10% for 1 year, but now it's back to 7.5%. In order to be able to deduct any medical expenses, it has to be over 7.5% of your income. So most people do not get to benefit from medical expenses due to this limitation. Another change they made was to home mortgage interest. Previously, if you had a mortgage that was under $1 million, you could take all of that mortgage interest and deduct it. If it was over $1 million, you could still deduct it, but there was a calculation on how much you'd be able to deduct. They did lower that to $750,000, but any loans that were taken out prior to 2018 are grandfathered into that $1 million. Another one of the major changes they made was that you are now only allowed to deduct $10,000 of taxes. And this includes income taxes that you pay to states, real estate taxes, and personal property taxes. It is important to note that this doesn't apply to any trade or business expenses. So if you're paying real estate taxes on a rental property, it doesn't apply. Or if you're paying any taxes related to your business, those are not subject to this $10,000 limitation. Charitable contributions, they increase the amount that you're allowed to deduct to 60%. And this doesn't affect many people except for those making extra large contributions for certain years. For the average person, that change isn't going to have too much effect. They did disallow payment for priority ticket purchases, which I know bummed out a lot of people in Tucson trying to get their basketball tickets. But unfortunately, those are no longer allowed. They did also get rid of all the miscellaneous deductions, things like your unreimbursed employee expenses, tax prep fees, investment fees, safety deposit box, things like that.
Hey, Derek, someone mentioned, can they deduct their monthly health insurance expense? I'm suspecting only if it goes over that 7.5% of income.
So that's one of the benefits of being treated as a business owner. If you're paying for your own health insurance, you are allowed what's called an above the line deduction for it. So even if you don't itemize your taxes, if you're a business owner, you can still benefit from your health insurance.
Awesome. Thank you.
One thing they did change that has been nice for a lot of people is they got rid of the Affordable Care Act penalty. Previously, if you weren't covered with health insurance and you made over a certain amount, you would have to pay additional taxes. That went away, so you no longer have to worry about that. And it also allowed for 529 education plans. If you have kids that grandparents are putting money in an account for them, you can now use this for their education for secondary schools or private schools, things like that. Whereas previously it was limited to college. Some of the changes on the business side, they did lower the tax rate for C corporations to a flat 21% rate as opposed to a tiered tax rate. And a lot of people kind of were impressed by this and wanted to switch their business structure over to be a C Corp. But we'll go over it in another slide or two, some of the benefits for S corporations, sole proprietorships, and partnerships that came from. They did also increase the limits for Section 179 expense and bonus depreciation. And what that is, as she mentioned before, if you buy a vehicle or a piece of equipment, these are the rules that allow you to deduct all of it in the first year. So one of the biggest changes from the Tax Act was the qualified business income deduction. And so all of you as business owners, whether or not you're a sole proprietor, a partnership, or an S corporation, all of the business income, you get an automatic 20% deduction for that. So if you make $100,000, there's a separate line on the tax return and you get to deduct $20,000. This was to kind of make up for the corporations getting a lower tax rate, so that kind of an even playing field for all of the entities. We often get questions on whether or not this applies to rental properties. And it kind of depends on the individual facts for each rental property. If your main job is managing various rental properties that you own, then yes, that would likely be qualified business expense. But they also did give us a safe harbor amount because so many people were asking questions on this. So if you personally spend 250 hours of service on a rental property, or if you pay someone else to perform service, that equates to 250 hours. The IRS says that that rental income qualifies for QBI deduction. There are a few restrictions on this, but normally those come into effect at high income levels. Any questions on the Tax Act before we go into the CARES Act? Okay. So CARES Act came about due to COVID this year, and it really had some major changes. The first thing that everyone was concerned about were the stimulus checks being mailed out. And that was $1,200 a person plus $500 per child, but it got phased out depending on your income level. Most people have received this already, but it's important to note that if you lost a job for part of the year or your income is low and previously you were making too much to get the check, any amount that you are still entitled to will show up as a credit on your 2020 tax return. So if you got laid off at the beginning of the year and were making a ton of money and didn't get a job again until a little bit later in the year and your income for 2020 is low, you will get all that money back on next year's tax return. The second major change from the CARES Act that's been getting a ton of media attention are the PPP loans. And I suspect a handful of you probably took them out. Essentially, they are loans for any business that's been affected by COVID. So essentially all businesses. And they have an interest rate of 1%, which is incredibly good. But if you use the proceeds from the loan for appropriate expenses, primarily payroll for your staff, then the loan can be forgiven. It's getting a ton of attention because the SBA made it very clear that when your loan gets forgiven, that's not considered taxable income. Normally, if you have a loan and the bank says you don't have to pay us back, you have to report that loan as income on your tax return. For these PPP loans, you do not have to do that, but currently the IRS is taking the position that any of the expenses you paid to get the loan forgiven will be non-deductible. So it's a little confusing because it essentially gets you to the same place. You don't have to pick up income, but you're not allowed to use those expenses. So we're really hoping the IRS comes out, later in the year and says something along the lines of they're not going to do that. But when we're going through our year-end tax planning, we're basically telling everyone that as of now, be prepared to pay tax on however much your loan was in additional income. The third big change from the CARES Act were some special rules for retirement. They did say that if you've been affected by COVID, you can take up to $100,000 out of your retirement account. Normally, if you're under age 59 and a half, you have to pay an additional 10% penalty on this on top of paying income taxes. But due to COVID, if you do this in 2020, there's no 10% penalty. And you may also choose to pay that tax back over 3 years. So normally you'd pay tax on $100,000 the first year, but you can elect to pay tax on essentially $33,000 for the following 3 years. The IRS also did add a provision saying that if you pay back what you take out, then you don't have to pay tax on the withdrawal. So that is another provision that was built in. They did also waive required minimum distributions. So if you're 72 or older, you normally have to take out a certain dollar amount from your retirement account every year. This, they figured since the stocks were all so low, they didn't want it to be detrimental to people. So they said for 2020, you don't have to do this. And for those people affected by that, it really led to some interesting tax planning opportunities. So if you are over age 72, it might make sense to talk to someone, and there's some opportunities to save some money.
Hey, Derek, if you borrowed from it, how long do you have to replenish it before you incur the tax?
I believe it's anytime during that 3-year period.
Okay.
And if you pay tax and then repay it, there's some special rules on how they kind of make up for that tax-wise. All right, so there's some planning opportunities built into the Tax Act that happened in 2018. So the first one is, like I mentioned, most people are going to be taking the standard deduction. But if you've got, maybe you want to make a large charitable contribution of $5,000 for the next couple years, you could decide to make that entire thing in 1 year and then not donate the next year so that you can still benefit from that. Another option is if your property taxes are normally only $5,000 and you're close to being able to itemize, you could prepay for a couple years and be able to benefit from those taxes in the current year. Normally, those required minimum distributions that we were talking about, you have the ability to say, no, I don't want to get that check myself. You can give it directly to a charity. And if you do something like that, then that doesn't become taxable income to you, which is beneficial because if you're not able to itemize, you're not able to benefit from any charitable donations. So being able to do a donation straight from a retirement plan to a charity, if you already want to make the contribution, is really a good saving tool. That's obviously not in effect this year because there are no required minimum distributions, but a lot of people don't know about that one, and it is a great savings tool. As a business owner, if you're planning on making any large purchases, say your income's up a lot and you wanted to buy that large vehicle for the business, simple thing of timing, doing it in December versus January can help lower your taxes. And then again, I'll emphasize maximizing retirement contributions. If you have the cash to make these contributions, you save on taxes now and it gets to grow tax-free. So this is really the biggest savings tool. You also, with the retirement contributions, have until the next year to make them because most of them are based off your taxable income. So the IRS doesn't expect you to know what that is by December 31st. So they say you can make these contributions all the way up until the tax filing deadline. So typically you bring your stuff to your CPA, they'll tell you your income's here, here's the maximum contribution you can make, and then you decide if you want to make it or not. In Arizona, there are also some additional benefits for charitable contributions. If you go on the Arizona Department of Revenue website, there's a list of thousands of charitable organizations. And if you donate to either public schools, private schools, a qualified charitable organization, qualified foster care organization, or the Arizona Military Family Relief Fund, you get that back dollar for dollar on your Arizona return. Most years they allow you to make these all the way up until April 15th, which is a huge benefit. Essentially, you get to give your money to a charity and then get it back on your tax return once you file it. So this is a huge savings opportunity. Previously, before 2018, you would actually make money from doing this because you would get it back dollar for dollar from Arizona, and you'd also get to deduct them on your federal return. After the Tax Act, the IRS said, no, if you get a state credit, you're no longer allowed to deduct these on your federal return. But they do say you can count them as taxes paid for federal purposes. So there is a little bit of wiggle room there. You are able to do all of them. And I've got the limits on here. The first numbers are if you're married, the maximum amount that you can get as a credit. And then the second numbers, if you're single, what you're able to deduct as a credit. All right, does anyone have any questions on any of this? Okay, well, I think I told Kayla to send out my email to everyone, and it is also in this PowerPoint. So if you have any questions come up, please feel free to reach out. We end of the year is kind of the best time to reach out to CPAs because you still have a couple months to complete any transactions that'll help save you money.
Hey, Derek, do we have access to the slides? There's people that want to try to pull some information off, and I'm sure that they'll will call you.
Yes, I have the slides and I will be emailing them out after this meeting.
Awesome. Fantastic. All right. Well, any last chance for any other questions? It looks like everybody got some great value. This has been a class I've been wanting to do for so long. So thanks so much, Derek, for taking your time. I know that our agents are going to benefit from the knowledge you dropped here today.
I have one quick question, Derek. If we make a contribution to an HSA account before taxes, is that tax deductible?
Yes. So contributions to an HSA are a separate line item on the tax return. So that gets deducted whether or not you itemize or not. You just want to check and make sure whoever manages your account that you're within contribution limits.
Awesome. That's fantastic. All right, guys. Well, we appreciate it. Thanks, Derek, again. You guys have a fantastic day. Go sell some real estate, and we'll see you soon.
Thanks for having me, everyone.
Have a great day.